Why do stock markets repeatedly crash? The answer is simple: human psychology. After the 1929 crash, stock prices plummeted a total of roughly 89% from peak to bottom in 1932. When the dot-com bubble burst in 2000, the Nasdaq index dropped approximately 78%. During the 2008 Lehman shock, the S&P 500 fell about 57%. Why do these crashes keep happening? This slide explains it all. Excessive optimism dominates the market. Investors start believing asset prices will rise forever. Prices completely detached from intrinsic value become justified. High leverage expands. Debt-financed investing surges, amplifying risk. A slight price decline triggers a cascading collapse. The illusion that this time is different spreads. Past lessons are forgotten, and the same mistakes repeat. People believe new technology or economic conditions have invalidated old rules. This is a fact proven by a century of financial history research, not speculation. Data-driven, established analysis. And this is understandable. History shows us. The patterns reveal it. Now you can understand the mechanics of crashes. Today, I'll show you that data. Crashes aren't about numbers. They start with psychology and are amplified by structure. The VIX Fear Index quantifies market fear. The long-term average is around 20. But when the VIX surges past 30, the situation changes dramatically. Investor fear expands rapidly. A chain reaction begins where selling begets more selling. Forced liquidation from leverage unwinding and liquidity shortages amplify the decline. Black Monday in 1987. The Dow plummeted 22.6% in a single day. This is known as one of the largest single-day drops in Dow history. The March 2020 coronavirus shock. The S&P 500 crashed 12% in one day. The VIX spiked to an extreme level of 82. Crashes start with psychology, but what amplifies the actual decline is liquidity drought and leverage unwinding. Panic dominates the market. How do you determine if stock prices are too high? There are two indicators: the P/E ratio and the CAPE ratio. The P/E ratio, or price-to-earnings ratio, is stock price divided by earnings per share. The historical average is 15. Levels significantly above this can signal overheating. However, the appropriate level changes with interest rates and sector composition, so don't rely on it alone. Use it alongside other indicators. The CAPE ratio, or Shiller P/E, is even more reliable. It's calculated using real earnings over the past 10 years. This eliminates the impact of short-term earnings volatility. The higher the CAPE during a given period, the lower the real returns tend to be over the following decade. Before the 2000 dot-com bubble burst, the CAPE ratio reached 44. Over the subsequent decade, the S&P 500 delivered nearly zero returns. And currently, the CAPE ratio exceeds 30. Conditions similar to historically cautionary levels are emerging, such as concentration in a handful of giant tech companies. History repeats itself, and the patterns are clear. After the 1929 crash, stock prices plummeted a total of roughly 89% from peak to bottom in 1932. The Great Depression began. The 2000 dot-com bubble burst. The Nasdaq index dropped approximately 78%. Thousands of companies disappeared. The 2008 Lehman shock. The S&P 500 fell about 57%. The global economy faced the brink of collapse. These three crashes share common factors. First, high leverage. In the late 1920s, margin trading expanded, and high leverage through buying stocks with minimal collateral became widespread. Incidentally, current regulations typically require around 50% collateral. In the mid-2000s, low down payment and loosely underwritten mortgages proliferated, accumulating credit risk. Second, rapid asset price increases. During bubble phases, the rise accelerates. What's crucial is that this acceleration and leverage expansion occur simultaneously. Third, regulatory loosening. Financial institutions gained greater freedom and risk management weakened. Systemic risk accumulated. Can we predict the next crash? Not perfectly, but there are clues. 3 warning signs. First, the inverted yield curve. Normally, long-term rates are higher than short-term rates. But when the 10-year yield falls below the 2-year yield, an inversion occurs. This is evidence that investors are pessimistic about future economic growth. In the U.S., when long-term and short-term rates invert, recessions have often followed within 6 to 24 months. However, the frequency and lead time vary by definition. In fact, an inversion occurred in July 2022, but as of early 2024, the U.S. had not entered a recession. In recent years, cases where this rule doesn't apply have also been debated. Second, credit spread widening. When the yield spread between investment-grade corporate bonds, such as bar-rated bonds, and treasuries widens, it's a danger signal. Corporate default risk is rising. Third, a VIX spike. When the VIX surges past 30, market fear psychology is expanding. Investors become defensive, and selling accelerates. The more these factors deteriorate simultaneously, the higher the alert level. However, prolonged inverted yield curves have also been observed, so signals must be evaluated over periods, not just at single points. Crashes are inevitable, but you can prepare. As a defensive strategy, allocating a certain percentage of assets, say 20% to 30%, in cash or short-term treasuries is effective. This secures liquidity. During a crash, it leaves you capacity for additional investment. Review your portfolio quarterly. Market conditions are constantly changing. Mechanical rebalancing prevents emotional decisions. When warning signs align, take action. The VIX spikes, an inverted yield curve appears, and credit spreads widen. When these deteriorate simultaneously, reduce risk assets gradually. However, the appropriate cash ratio and effectiveness vary with investment horizon and acceptable loss. While it's established that asset allocation significantly impacts risk, there's no universal formula. During the 2008 Lehman shock, many investors lost half their assets. But investors who prepared drastically limited their losses. Now, let's organize today's analysis. Here's the summary. First, the mechanism of bubble formation. Excessive optimism, expanding high leverage, and the illusion that this time is different caused the roughly 89% decline during the Great Depression from 1929, the approximately 78% drop in the 2000 dot-com bubble burst, and the about 57% fall in the 2008 Lehman shock. History repeats itself. Second, reading the warning signs. Inverted yield curves tend to precede recessions, but frequency and lead time vary by definition. In fact, the prolonged inversion since 2022 has shown exceptional phenomena where traditional rules don't apply. Credit spread widening, VIX spikes. The more these deteriorate simultaneously, the higher the alert level. Third, concrete preparation methods. As defensive measures, secure a certain percentage of assets in cash or short-term treasuries. Review your portfolio quarterly, and if warning signs worsen, reduce risk assets gradually. The appropriate ratio varies with investment horizon and acceptable loss, but preparation enables defense during crashes. If you're an investor, can you afford to ignore these warning signs? Crashes are inevitable, but you can prepare. Let me know your thoughts in the comments. Thanks for watching. Stock market crashes can be understood through patterns, not emotions. This channel reveals market truths through data and history. Subscribe to the channel and join me next time to understand market mechanics. Turn on notifications, and with each new analysis published, your investment decisions will level up. I'll see you in the next deep dive.